Very quickly, my introduction. Yes, I'm Shubho Kundu, financial advisor. I work for, represent St. James's Place. And I know a few of you, not many of you, of course, right? So, like Nandalal, I know, and Shoma Bho, who put my name in your group, right? Dr. Shoma Bho Mongol. He's my friend. And then there is Shantanu Acharya. So that's how I came to know of you guys. So thanks for inviting me. So we will start I've got a structured a PowerPoint presentation, but that's merely is a structure, nothing more than that, right? That's a structure to start and to keep our conversation within a particular range, right? But I had already requested Anup and Vivek to get some pre-submitted questions. I got in total 30-ish, and if I take away the common ones, there's still 25. And then I was going through the chat. There are quite a few already come in, right? So I will try attending all the queries as good as possible, as well as possible. If not possible in this particular webinar, I will continue it in the next one as Vivek suggested. Let me start with the first query, which Nandalal posed. Is NHS, we are spending so much time to know about NHS pension scheme. Is it a good one, right? Yes, with my 30 years of experience, I can vouch that when you say good or bad, it's always relative, isn't it, right? So we define something to be good, comparing it with other pension schemes available at this moment in time, not in past, at this moment in time. So this is one of the better ones, if not the best, and it's a scheme. Even if in a 2015 scheme, right, they have been moving the goalposts, but it is still reckoned as one of the better schemes because it's final salary, it's career average, right? So that's the starting point. So I'll quickly go to my slide. I'm sharing the PowerPoint presentation now, and we'll keep that as a structure and then build on that, right? So I will skip the stuff that we don't really want to hang on to. So since I told you that we will start from level 0, let's come to NHS pension schemes, plural. So whoever joined the NHS medical fraternity as an organization, and if they opted in, because I know from my experience that some of the doctors initially discussed with their financial advisors and decided not to join the scheme. But whoever joined the scheme before and joined NHS before 2008, they joined the 1995 scheme. So I will quickly go to the other screen where it says how 1995 scheme looked like. So can you see 95, 2008, 1995, and then 2015 at the end? And it does cover the consultants as well as the GPs. Very simple. Given the current circumstances, NHS 1995 scheme is the best one. There are many features. I will explain just 3 of them, most important. It has got the lowest retirement age of 60. So whoever joined the 1995 scheme and were into that particular age category where they didn't have to join the 2008 or 2015 scheme, they have got only one scheme in place, which is 1995 scheme, and they can retire at when they are 60, and they will get the stipulated pension plus a tax-free cash, which is a lump sum one-off payment, right, on top of the regular pension scheme, pension payments, right? And if somebody can recollect their total reward statement and pension statement, they can remember that there are 2 options. If option number 1, if they want the maximum pension and the tax-free cash along with that, or option number 2, they want the maximum tax-free cash lump sum and a reduced pension, right? These are the 2 options. And whenever people opted for the second option, where they want the maximum tax-free cash, then their pension will be reduced in a ratio 1:12. That means if they chose to take tax-free cash maximized, for every 12 pounds of additional tax-free cash lump sum, they will lose 1 pound from their NHS pension. And there's a maximum how much tax-free cash lump sum they can have. So one is minimum age of retirement, two, tax-free cash lump sum by default, right? So these are the two main features of 1995 scheme. There's a third one, which is it's not a benefit, it's a feature, that for every single year of being in 1995 scheme, their pension will go up by 1/80th of their final salary. Now, the moment I mention final salary, that becomes a better feature of 1995 scheme, because all of these are defined benefit. All of these are calculated through formula, be it 1995 scheme, be it 2008 scheme, be it 2015 scheme. They have got different formulas, but they are all calculated. The pension eligibility is calculated through a formula. In case of 1995 scheme, the formula is whatever is your best salary, pensionable wage, of course, when I say salary, in the last 3 years of your working life. So that means if you are retiring at age 60, they will take look at your pensionable wage when you are 58, when you are 59, and when you are age 60, and they will take the maximum amongst those 3 years, and that will be reckoned as your final salary. So coming back to the formula, 1/80th of pensionable pay per year, which is a final salary as I defined, time by number of years you have been in that NHS pension scheme. So if somebody has worked for 20 years in that scheme, it will be 1/80th, and hypothetically, if their final salary, according to the definition, is 100,000, to keep the calculations simple, 1/80th times 100,000 times 20, because he has, in this particular example, worked for 20 years in that scheme. So it is 1/4 of 100,000. That means 25,000 will be his pension at age 60. And by default, he will get 3 times of that 20,000, 25,000, which is 75,000 of tax-free cash lump sum. What happens if somebody, because one of the questions probably was that can I defer? Of course you can defer. At age 60, imagine you hit 60 today, and when you're 60, you found out that, no, I'm still, I can carry on. I can probably carry on another couple of years, right? I want to work full time another couple of years. So what happens to that 25,000? It increases in line with CPI, right? If it's a deferred pension, if you're not taking the pension, because you may be member of 2015 scheme. So your pension contribution is going into 2015 scheme, and this 1995 scheme is deferred, but it doesn't remain same. It goes up in line with CPI. Since we have started defining the pensions, let's come to 2008 scheme. Now, if you can remember choice 1, in 2017 April, the members, that means the doctors, the clinicians, the GPs, started getting in letters where it says that we are starting a new scheme 2008 because we couldn't sustain the 1995 scheme. We have got huge shortfall in the pension fund, NHS pension fund. So we have to tweak the pension scheme. But the good thing is that we are not doing it retrospectively. We are doing it from a futuristic date. That means your accrued pension pot as of now will be secure. We are not going to touch it, but we will stop collecting contribution. If you opted choice 1, we'll stop contributing collection towards 1995 scheme. And if you have opted into 2008 scheme, your membership will be pension contribution will be diverted towards the 2008 scheme. And the formula for 2008 scheme was that, first of all, the retirement age. Unfortunately, they couldn't pay the whole pension at age 60, so they increased the retirement age to 65. That's one of the most important features, difference in features. Age 65, the accrual rate is 1/60th, and there is no by default tax-free cash lump sum. So these are the differences, and there's one more very important difference, the definition of final salary. For 2008 scheme, the definition of final salary is they will look into lots of three, first, second, third, last 10 years. They'll look into last 10 years and they will see lots of three. First, second, third, fourth, fifth, sixth, and so on and so forth until 7, 8, 9, 10, 8, 9, 10. And whichever 3 consecutive years average salary, pensionable salary is the maximum, they will take those 3 consecutive years. It has to be consecutive years. It can't be first, 7th, and 10th. No, it has to be 3 consecutive years where the average pensionable earning is the maximum amongst those 10 lots of 3. If you do the combination and permutation, right, whichever is the maximum one. So 1/60th of the so-called average final salary times the number of years. So with a very simple example, if somebody has worked for 30 years in, or let's call it same 20 years. 20 years in 2008 scheme, it will be 1/60 times, since the number of years is 20 times the average final salary. For making it easy in this example, let's assume that the average final salary is 100,000 in this case also. So it will be 1/60th times 100 times 20. So it will be 1/3 of 100,000. So can you see the pension for working same number of years in a 2008 scheme is more than 1995 scheme, and that's the compensation. That means the accrual rate is slightly higher in case of 2008 scheme. In this particular example, it will be 20/60 times 100, which is 33,333 pounds, right? That will be the pension when he hits age 65. And there won't be any tax-free cash lump sum by default. But like the second option, as I explained in 1995 scheme, there will be a second option in this 2008 scheme also. If somebody wants to take tax-free cash lump sum up to a particular stipulated limit, they have to forego their pension. So tax-free cash lump sum will increase from 0 to a particular level, but their pension will go down in the ratio 1:12. And then fast forward, again they found out in the year 2012 that they can't sustain even 2008 scheme, right? So they have to change the goalpost again. So they said, now this is very interesting. They said, as on 31st of March 2012, whoever is within 10 years of their 1995 scheme pension age, that means whoever is 50 or more than 50 years old as on 31st of March 2012, by default, they don't have to join 2015 scheme because they're within 10 years of their retirement age. And that basically is the crux, the reason for the the consultation paper, McLeod judgment. I'll come to that, not now, towards the end. And that was reckoned as discrimination against younger doctors, right? I will park that for the moment, but let me explain 2015 scheme first. So 2015 scheme said that whoever is within 10 years on that particular date of their age 60, they are immune. They don't have to join 2015 scheme. On the contrary, on the opposite, if somebody has got more than 13 years left as on 31st of March 2012, before they are 60, that means they have to be 47 and below that age, 45, 46, etc. and below age. They have to join 2015 scheme by default, no option, by default from 6th of April 2015. They will stop contributing to their existing pension scheme and all their membership will go towards 2015 scheme, no option. And then there came the gray area, people who are between 10 and 13 years of their retirement. They said that you'll have to join 2015 scheme, but not from day one, that is not from 6th of April 2015, but in a tapered manner until 2022 April, 1st of April or 6th of April, right? So these are the, I wouldn't linger more on this because I needed to define 2015 scheme so that I can go back to the other things. So definition, how your 2015 scheme pension is calculated is again through the formula. And this type the formula is, there are three major changes. You're not retiring at age 60 or 65. Rather, your retirement age, normal pension age as they call it, NPA of NHS scheme 2015, will be state pension age. Now we know that state pension age keeps on changing, 60, 65, 66, 67, 68. So whatever age group you are in, whatever your state pension age is, your 2015 scheme pension age will be, normal pension age will be that age. Now if your state pension age is 67, then your 2015 scheme pension age will be 67. If you are slightly older, then your state pension age is 66 or 65, then 2015 scheme's pension age will be 65, 66. Or if you are slightly younger, if your state pension age is 68, then your 2015 scheme pension age will be 68, but it will always be linked to your state pension age. So in future, it keeps it open. That means in future, if the HMRC and DWP changes the rule again in state pension age and decided hypothetically, they haven't done it, hypothetically, if they further defer it to age 70, unfortunately, the 2015 scheme NPA will become 70. I'm not saying it will, but I'm talking about the potential or possibility. The formula is 154. That means the accrual rate, we call this 180th, 160th, 154th accrual rate. And you can see, though they're making the scheme less attractive, but they're trying to partly compensate that by increasing the accrual rate ever so slightly. So 154th times the number of years, that remains same, times carrier average revalued earnings. Now somebody had asked me about the revaluation rates. Of course I will answer it later on, but to keep it simple, mind that it is 1.5% plus the stipulated percentage, which is usually the CPI, Consumer Price Index. So in a year, in a simple example, if the CPI is 1% and that fixed revaluation rate is 1.5, they've already given. So your pension, when revalued next year, will be multiplied by or adjusted against that 2.5%. What is that 2.5%? It is 1% plus the 1.5%. I will explain it in a better way later on. I'm just touching and going for the time being, right? So whatever your, so for example, you are in your third year of your 2015 scheme. So for the year 15-16, your career average, that means it was the first year in your 2015 scheme because it only started from 6th April. In the first year, no revaluation required. So you have got 2015 scheme with the same example, 100,000. So individually for that particular year, your pension accrual will be 154 times 1, because you have only been 1 year in that scheme, times your 100,000. And then next year, they will take this first year times the revaluation rate, because there has to be some inflationary adjustment. So they will multiply it with that revaluation rate and then add it to the second year, which is 2016 or 2016-17 years pensionable earnings. So in a third year, they will take first year and second year, revaluate and add it to the third year. In the fourth year, they will take first, second, third, revaluate and add it to the fourth year. That's how your 2015 scheme pension is calculated. Now, some of you do ask me, can I take my 1995 scheme pension, or if I'm a member of 2008 scheme at that particular pension age, respectively 60 or 65, before taking my pension through 2015 scheme? The answer is yes. The answer is yes. I can take my deferred pension scheme once I hit the normal pension age of that particular scheme, which is respectively age 60 for 95 scheme and age 65 for 2008 scheme, but still continue contributing into my 2015 scheme until I am reaching the normal pension age of 2015 scheme. Now, very quickly, this is consultant. Very quickly, I will compare this with GPs, right? So in case of GPs, what happens? They were always in career average revalued earnings. They were always in career average revalued earnings, right? So this particular screen is for GPs. So what was their formula? Their formula was that whatever the pensionable earning is in a particular year, you revalue it every year, and the revaluation rate was not 1.5% plus the CPI. The revaluation rate would come from the NHS every year. So there was absolutely no way of knowing what the next year's revaluation rate is going to be. It has to come from NHS, and it used to come, and it still comes retrospectively. That means only next year it will come for the last year, right? And we know that it is somehow linked to the inflation rate of the past year in the month of September. They take the inflation because every month the Bank of England publishes its inflation rate every month. So instead of taking the whole years and averaging it out, they take the inflation rate published by Bank of England in the month of September of the last year. So for the revaluation rate of 16-17, as in April 2016, which is beginning of the year, they will take the inflation rate as it was in September 2015, which was part of 15-16 year, last year's September's inflation rate. So that first year's pensionable earning, when you go to second year, they will revalue the first year's pensionable earning to adjust it against inflation, add it to the second year, and then third year, they will take first and second year, adjust it, revalue it, and add it to the third year. And if you have been in the pension scheme for last, say, 15 years, that's the way. So all the years' pensions will be taken, revalued, and then whatever the final total sum of the revalued earnings is, if you are a member of GP 1995 scheme, 1.4% of that big pensionable earning throughout your career will be your accrued pension. So 1.4% of the GP income. 2008 scheme, they kept everything same, just they changed the retirement age from 60 to 65, and no lump sum tax-free cash, and slightly better accrual rate. Instead of 1.4%, it is now 1.87% in 2008 scheme. I'm talking about GPs now, right? And then 2015 scheme, now the GP's calculations and the consultant's calculation has become same, right? So it is 1/54th of the GP's income in that particular year. Of course, every year it will be revalued in the next year. So that's how all the three schemes are, right? 1995, 2008, 2015 scheme. You can't, very quickly I'll show you what happens if somebody said, I am 62 now. In my simple example, I'm a member of 1995 scheme, and I'm also a member of, sorry, let me stand corrected. I'm a deferred member of 1995 scheme, and I'm a live member of 2015 scheme. I'm age 62 now. Of course, I've received NHS pension statement and a letter from them that if I want, I can take my full pension without any deductions from my 1995 scheme, because I've hit my normal pension age, NPA, of 60 through 1995 scheme. So my question, Shubho, to you is, what happens if I want to take my pension from 2015 scheme? Here is the answer, right? If you can look at the scheme. First of all, the accrual rate, which I just now told, that treasury order plus 1.5% each year. That's the revaluation rate. And then if somebody, if somebody is trying to take their pension 2015 scheme, these are they call it actuarial reduction. They call it actuarial reduction. So you are supposed to retire at age 67 through your 2015 scheme, but you are trying to take it on when you are age 62. So you are taking it 5 years earlier. So look at this table and go to 5. So your pension will be reduced by 24%. If you are trying to, so this is published by NHS, and if you go to ARER fact sheet, or if somebody emails me, I can share this with you. You can respectively calculate that if I want to retire 7 years early at age 60, then my reduction will be, actuarial reduction will be 31%. So you may call it early pension withdrawal penalty, but the actual nomenclature is actuarial reduction, right? So that's how the treatment of your pension is. But if you are not willing to forego or reduce your 2015 scheme pension eligibility, then you have to wait until age 67. Because the moment you try to draw from it before your age 67 or your respective state pension age, I'm giving the example of 67, your state pension age may not be 67, it may be 66 or 68 or 65, right? So whenever you are eligible to draw from your 2015 scheme, if you're trying to take it earlier, there will be some actuarial reduction. So only way of getting the full 2015 scheme pension eligibility is to draw from it at your stipulated normal pension age. I will cover the ERRBO. This was one of the questions later on, but let's go to the slide first. The first slide, my presentation slide. Sorry, it is generic, right? So many things is there. Right. Now I am aware that I am addressing a varied group. I can see there are how many? 84 already members currently attending this particular webinar. The variation is through age. So some are probably as old as 38, 39, 40. Some of them are without being, age discriminatory. But yes, some of us like me are mature in 50s, early 50s. Some of them may be early 60s. I don't know. So I'm guessing. And some people are from Scotland. Some people are from England and Wales, right? Some people are only member of 1995 scheme. Some of our 2008 scheme. Some of our both 95 and 2008, or maybe 2008 and 2015, 1995 and 2015. Some are GPs, some are consultants, registrars, right? So there is a varied group, heterogeneous. So I'm mindful of the fact. So that's why I have drawn, to give you a flavor, what's the tax rates in Scotland. This is Scotland, right? So, but in England it's slightly different. So you have to factor in the difference in the tax rates at the thresholds. Now, this is the bit which I have already covered, that how your pensions are calculated. Now comes the most important things, which is the lifetime allowance and the annual allowance. So let me explain the two main limitations of your pension. When I say pension, I'm not talking about NHS pension. I'm talking about any pension, barring except your state pension. So if you've got a SIP or personal pension outside your NHS, and if you've got membership in 1995 scheme, and you're a member of 2015 scheme, or you are not a member of 1995 scheme, you're a member of 2008 scheme and 2015 scheme, in all cases, there are two limitations. One is a longer term lifetime limitation. That means there used to be a time when you could have pension pot of unlimited size. Gone are those days. So they started tapering in from 2011-12 onwards. And then currently, without going much through the history, they are currently 1.0731 million, right? So they have been reducing historically. So currently, it's reduced to 1.073 million. What does it mean? Now, before I can explain this, I'll have to explain that there are generically two types of pensions. First, the simple type of pension, right? Whoever is in private sector, like I am, or whoever has got some private pension or SIP or personal pension, is very simple. In a year, Your contribution goes into that, and then it's invested in stock market. And on a given date, whatever the fund value is, whatever the stock market fund value is your pension pot size through that personal pension or SIP. If it's, to keep example simple, if it's 100,000 as of today, if I'm looking at your pension pot size, total pension pot size as of today, 3rd of January 2021, let's say that yes, you have got a private pension and it's 100,000 as of today. You went online and found out 100,000. Plus, you'll have to add up what is your pension pot size through NHS. Now, there comes the complication. When I told you there are two types of pensions, in your pension for personal or private or SIP, it's the fund value. In case of NHS pension, it's not the fund value because there is no fund, because it's a pool of fund. So how is your pension pot calculated? Your pension pot is calculated, mind that, right? There's a formula. It is 20 times of your pensionable wage as on a particular day your total pension. Say, for example, I know that you can't have your pension pot calculated for NHS as of today because you only get statements at the end of the tax year. The current tax year hasn't finished. You don't get the pension pot size every day. So the last tax years for consultants finished on 31st March or whatever you want to call it, 5th of April 2020. So in October, they updated your TRS, total reward statement, and pension statement. If you go to the government portal or NHS BSA portal or ERS portal, you'll find out, if you are a consultant and if you're lucky, if the calculation is up to date, your pension, annual pension, as on 5th of April, 6th of April 2020. So if you take that value, and for GPs, unfortunately, GPs is slightly more delayed, because what happens, the tax year you finish on 31st March or 5th of April 2020, you don't pay that tax return until 31st of January 2021. So you haven't filed your tax returns as of today for the tax year finished in April 2020. So once you file your return, which is last date is 31st of January 2021, then NHS will get the figures from the taxman, and then they will do the calculations, and then probably they will publish your pension eligibility or accrual in the TRS, ERS. So there's usually 2 years gap. For consultant, it's roughly 1 year gap, and for GPs, it's usually 2 years. But if there was any mismatch in the past and everything, I know I've got 175-ish clients who are solely doctors. And a lot of them, especially GPs, are not happy because they don't have their up-to-date pension statements in TRS. And they are pursuing, I'm helping them pursuing, and sometimes they have to escalate to ombudsman. Sorry, coming back to the current screen. Imagine you have got your 1st April 2020 figures. So formula says pension eligibility or amount, time it by 20 and add the tax-free cash. And use the formula for both the schemes, your 1995 scheme or 2008 scheme and plus 2015 scheme, and add them up. So in a simple example, your pension through 1995 scheme is 20,000. Time it by 20, so 400,000, and then 60,000 is your 3 times of your pension amount, which is 30,000, 3 times of 20, so 60,000 is your tax-free cash lump sum. So the total value will be 20 times 20, 400,000 plus 60, 460. Similarly, apply the same formula for 2015 scheme. And imagine, since you in 2015 scheme you have been for a shorter period, let's call it 10,000. It probably is higher, but to keep mathematics simple, let's assume that your 2015 scheme pension shown in your TRS online portal as of now for the year ended 1920 is showing us £10,000, no tax-free cash in the first option, where you are not taking any tax-free cash, right? So 10,000 times 200,000. So your pot size is 660 from here, sorry, 460 from here, and 200,000 from 2015 scheme. So you have your total pension pot is 440, 460, and 200,000, 660. And the total standard lifetime allowance as of 2021 is 1.0731 million. So you still have half a million-ish headroom, right? Whenever I'm saying something, I'm conscious of the fact, because I've done loads of seminar, not for a big size like this, but 2025, loads of them in the last 7-8 years. I know usually when I'm explaining something, there are so many thread questions which are customized to your own circumstances. So I'm more than happy to answer those, but not now. When you submit all the questions and Vivek or Anup collate them and send it across to me, right? So that's how it will operate. Or you can contact me directly if you want, right? Subject to Vivek and Anup's approval. Right, coming back to this. So that's how your pension pot size is calculated, not the fund value as on a particular date. But mind that your total pension pot size through NHS is 660 in this simple example, but you have got 100,000 in SIP. So your total pension in UK pot size is 660 plus 100, 760. So you've got roughly 1.073 minus this 0.660. If you subtract that, you've got a headroom of say another half a million, right? Or 400,000-ish, 413,000-ish, right? So every year your pension pot goes up and you have to do the same calculation. Now imagine you are say 55, 56, 60, 50, and your pension pot sizes are a lot higher. And you went over that stipulated, because this lifetime allowance, they are increasing it every year in line with CPI. The last September, 2020 September, CPI was 0.73%, 0.7%, right? Quite low because of the pandemic and the economic downturn. So next year, it will go up by 0.7%, lifetime allowance. So whatever the lifetime allowance is, and as on a particular date, when you are looking at your pension pot, imagine you are already over and above your lifetime allowance by say 200,000. This is totally plucked from the air. Imagined figure. You are over and above your lifetime allowance, stipulated standard lifetime allowance. There's a reason why I'm calling it stipulated standard lifetime allowance, right? I'll define that in a second. If you're over and above your lifetime allowance, standard lifetime allowance, you have to pay lifetime allowance charge to the taxman, HMRC, right? And the way it is calculated, the second bit of this slide you can see, the way it is calculated, the HMRC will give you two options. Sir, do you want to take the additional amount over and above your standard lifetime allowance as cash? If the answer is yes, you pay 55% of that 200,000 pot and take the rest 45%. So give us 110 and take 90 out of the 200, which is over and above the stipulated lifetime allowance. Or if you don't want to take it as lump sum, one-off cash, then you keep it within the pot and draw the income. So what they will do, they will deduct 25% of that 200,000, which is 50,000. So 150,000 will be put in your pension pot and you will be drawing income out of that. And when you draw income, of course, you have to pay your normal tax. If you're a 20% taxpayer on retirement, you pay 20% tax on that additional amount. If you are a 40% taxpayer, then you have to pay your highest marginal rate, which is 40% tax. Now, I have got tables, which probably will be a discussion in the next meeting, where I can show that if you remain 40% taxpayer even on retirement, which many of you will be, then there is no difference between the two options, whether you want to take it as lump sum from the additional amount over and above lifetime allowance, or you want to draw it as income. In both cases, you end up paying de facto 55% charge, right? So we'll pause on that. We'll move on from here. Of course, you're free to ask me questions later on. So that's how your lifetime allowance is calculated. What was the next second bit of limitation I talked about was the annual allowance. But before I move on to annual allowance, I'll quickly tell you why I did mention stipulated standard lifetime allowance. Because government, DWP, HMRC have changed the amount of lifetime allowance so many times in the past. And when they made the change, there are loads of people who are already very close to that limit or just over that limit. And to be fair to those members, they didn't want them to be in an disadvantageous position because of this change. So they allowed them to protect their pension pot. So historically, there have been different types of protections: individual protection, fixed protections, right? Fixed protection 2012, 14, 16. So last one, which is currently still available, is fixed protection and individual protection 2016. After that, they haven't changed the lifetime allowance. It was 1.25% until March 2016, and from April 2016, they decreased it to 1 million. And then from 2017 onwards, they're increasing it in line with CPI gradually. And that's why 1 million became 1.033, 1.055, and then currently 1.073. So if you are a pension member and you can add all your pension pots, NHS pension 95 or 2008 plus 2015 scheme plus any private pension you may have. I know some from experience, some of you do have life insurance of India, UK pensions. Few and far between, but some of you do have. You have to include that as well, right? Because some people, some members who came from countries like India and all, initially they thought that they'll go back and they took some memberships through Life Insurance Corporation and Indian pension schemes. So you have to add that, sorry. So if your total pension pot size as on 31st of March 2016 was over and above 1 million, if your pension pot size was over and above 1 million as on 31st of March 2016, then you can opt for fixed protection or individual protection 2016. Now you can't opt for fixed protection if you have continued contributing into your NHS pension even after that date. Then fixed protection is not valid, because fixed protection necessitates or requires that you stop contributing into pension even in NHS. It won't charge you for going above that limit if it normal accruals through CPI increases. But if you're still contributing, if you're a live member into that pension scheme, then you can't have fixed protection. The only option is individual protection. So my request will be to all these 84 members, 90 now, that whenever you get a chance, if you can, calculate your total pension pot size, but you have to pull out your pension statements as on 31st of March 2016 and find out, some of the senior members maybe, and GP especially, right, who had been contributing a lot more sometimes. So look at your pension statements as on that date, and if it added up more than 1 million, then you need to apply for individual protection 2016. Sorry, coming back to annual allowance now. And this is a big thorn of bone of contention, thorn in the back, right? That means it is affecting, lifetime allowance is affecting you when your pension pot size is too large towards end of your career, when you're a mature member. But annual allowance is affecting you every year. It's every year, and they have made it more complicated with the tapering of it. So I will spend some time on this. And as I mentioned, I will be encouraging all your linked threaded questions to the topics I'm discussing. As you can see, I'm not skipping, hopping and jumping. I'm following a smooth path. I've defined all the pensions. I've told why it is good, because it's fixed, it increases with CPI, it's guaranteed, right? And then I'm defining what are the limitations in the pension. So I'm following a flow chart, smooth flow chart, right? But you would have questions. which are linked to the topics I'm discussing and linked to your personal circumstances. Don't stop yourself from noting down those questions or escalating those questions to Vivek and Anup, and I'll collate them later on and answer them when I get a chance. Right. So what is your annual allowance then? We have discussed lifetime allowance. That's a different type of limitation. This is annual allowance. So your tax year starts from April, finishes on next March, 6th April to 5th of April, let's call it. You are only allowed to contribute, now mark my word, contribute or have growth in your pension. I will define why I'm using these lingo or nomenclature. You are only allowed to contribute or let grow your pension by a stipulated amount per year. It has to be historically 255,000, 50,000. So those are history now. So we are not bothered about that. 40,000 is the current amount. And it can be even later, even smaller, if you are affected by certain rules, right? But I won't complicate it now. I'll keep it simple. Let's call that your standard annual allowance is 40,000 because that is your standard annual allowance if you're not affected by tapered annual allowance, right? So in a year, you can let grow your pension pot or contribute only 40,000 in total. If you've got NHS pension and if you've got private pension, both added together, it can't be more than 40,000 plus. If you have got some unutilized carried forward annual allowances from the last 3 years. So currently we are in 2021. Now we know that NHS gives or lets you the annual allowance statement not by choice but by default. That means if only you have gone above your 40,000 in the particular tax year, they will only send you a letter. Otherwise they won't calculate because they have got a resources problem. They won't calculate or they won't send you any annual allowance statement. So if you haven't received a letter from NHS, that means you most likely haven't gone above your annual allowance. When they say annual allowance, they are not looking at your last 3 years unutilized carried forward annual allowance. This letter is only triggered, this type of letter from NHS is only triggered if you have gone above your annual allowance of 40,000, standard annual allowance of 40,000. In the year, they are issuing you the letter and they don't take into cognizance your private pension because they don't know. NHS doesn't know about your private pensions or SAPE, right? So they will only send you the letter if your pension growth, now is the time I will define it. If your pension growth in NHS combined between your 1995/2008 scheme plus your 2015 scheme is over and above 40,000 pounds. So if you want to know where do you stand, if you haven't already received a letter from NHS, then you have to request for it. You'll have to request the annual allowance department in SPPA for Scotland or NHS BSA for England and Wales if you want to know about it. If you haven't received a letter, because most likely you haven't gone above 40,000 in the last tax year when they last calculated updated your TRS, total reward statement. You need to know those figures because unless you know that, you don't know how much carried forward annual allowance have you got. And if you are already contributing X amount in your private pensions, you definitely need to know because otherwise you don't know in a year whether you are going to go above your stipulated annual allowance or not. So I reiterate before I go and define why I said pension growth and pension contribution. Reiterate that annual allowance is compared against your growth and contributions for both NHS pension schemes, all the two schemes you are members of, deferred and live members of, plus your contribution into your private pension if you got a private pension in that particular year. If you once contributed in 2002 and never contributed after that, or 2015 never contributed after that, then it's not bothering you. Have you made any contribution in the tax year under consideration? If the answer is yes, then you need to add that. And on top of the current year's 40,000 annual allowance, standard annual allowance, you can carry forward your unutilized annual allowances from the last 3 years. For 2021, the last 3 years will be 1920, 1819, and 1718. The years before that are very important but not required for this calculation. Why very important? Because in 2017, 18, 18, 19, if you went above your annual allowance, then you can offset it for the last 3 years from that tax year. So unless you know the last 3 years from that tax year, you can't know what was your annual allowance charge liability in that year. So that's why you need to go back probably until 2011-12, if provided any of the years you went above 40,000, because you don't pay any annual allowance charge unless you have seen whether you had any carried forward annual allowances from the last 3 years, right? So you need to look back. Now is the time to define pension growth. At the beginning, I told you that there are two types of pension schemes: private pension schemes and NHS pension schemes. Private pension schemes are called defined contribution or money purchase, and NHS pensions or teachers pension or civil service pension, they are all called defined benefit or final salary and currently career average revalued earnings, CARE scheme. GPs, it has always been career average revalued earnings, CARE. There's a difference between the way we calculate the annual allowance for a private pension and for CARE or final salary scheme. Private pension is very simple. Whatever amount you have contributed, and if it's an occupational pension, whatever amount your employer contributed, sum total of that, that's your total pension contribution. If you have contributed 10 and your employer has contributed 10,000, 20,000 is the total contribution, full stop. But it's not that simple for your CARE or final salary scheme. Good thing is that I've got currently, in the recent past, have had some clients in Scotland, right? I don't know, Shantanu, are you here? Or right? So now SPPA statements when compared to NHS England.
Yes, I'm there.
Yeah, hi Shantanu, right? Okay, so I just mentioned you because the statement you get received from SPPA, right? That does the calculation of LTA and annual allowance for you. You don't have to bother.
And both schemes they do, yes.
Correct. So you straight away, they will not only give you that how much your 1995 scheme stroke 2008 scheme lifetime allowance you have used, how much 2015 scheme lifetime allowance you have used, and what is your total lifetime allowance used, what percentage you have got left. But in case of NHS Wales and England, they don't. So you have to calculate or let your advisor calculate it. In case of annual allowance, right, you don't get a letter, as I mentioned, unless it's triggered. Unless it's triggered. So if you have gone past, then only you'll get. And now this is the time. Vivek, are you there? With your permission, I'm pulling up. One of the members, I think, submitted something with you, right? So there are some members. I don't know. No, probably in this particular list, that particular member is not there. So this is one of my clients, right? Of course, anonymous clients. I have taken his permission to show the generic pension statement, and it looks like something like this. Anup, can I show my slides?
Can you hear me?
Yeah, I can hear you.
Yeah, please go ahead.
Yeah, thank you very much. Yep. Right. So one of my clients, they have got this particular statement. You may be familiar with this, right? If you have received one from NHS England, Wales or SPPA, more or less similar. So it will first of all show you, if you can look at the top, this is 95 or 2008 scheme. And
just to add, it's a consultant statement, so very relevant for the hospital doctors. Carry on, Kondu.
Yeah. It will be similar for GPs as well, provided it may not be up to date until 1920. Of course, it says consultant somewhere, and sometimes it can be GPs also, but they will look almost similar, right? So in a case of you being a member of 1995 scheme only, so you will receive a statement like this only. But if you've got membership in 1995/2008 plus 2015 scheme, you'll receive two such statements, probably together. So in one of the statements, you'll see, I'm trying to get the cursor at the right place. So over here, your pension growth in the year 1920, 11,624. And in 1819, your 95 scheme, 2008 scheme went up, or the pension growth was 8550. Now the difference between private pension and your NHS pension is that private pension, I just defined sum total of the contributions. But in case of NHS pension, there is a formula. I'm going to tell the formula. You don't have to remember. I'm going to tell the formula, but you don't have to remember. So on a particular day, whatever your pension amount is at the beginning of the tax year. So for example, you are trying to calculate your annual allowance growth or the pension pot growth in the year 2019-20. So in the month of April, 1st of April 2019, that's the beginning of the tax year, and 31st of March 2020 is the end of the tax year. So first of all, I need to know how much is your pension through 1995 scheme or 2008 scheme at the beginning of the tax year. Time it by 16, and add the tax-free cash on top of that. So if your pension is 20,000, time it by 16, 320,000, and 60,000 tax-free cash, 320 plus 60 is 380,000. And then adjust it against the inflation for the year. And hypothetically, if the inflation was 1%, so multiply it with 101%. 100 plus 1%. That's how the formula is, right? You don't have to remember this. I'm giving you a flavor how it is calculated, right? So 101% of the pension pot, the way I calculated, 16 times of your pension plus the tax-free cash, and adjust against inflation. That's your P1. That means beginning of the tax year pension. And then find P2, end of the tax year pension, which is pension statement, how much pension is in the 1995 scheme at the end of the tax year. That means 31st of March 2020. Similar, use the formula, 16 times your pension. If beginning of the tax year your pension was 20, it is probably now 23 or 22, 500, because it's slightly gone up in 1 year. Time it by 16 and add the tax-free cash. Don't adjust it against inflation. That's your P2. So now you've got two sets of figure, P1 and P2. Subtract P1, the smaller one, from P2. That's the growth in your pension pot. Now, why I had to mention this formula? Not because I'm testing your IQ or anything, or trying to test my memory. No. I'm mentioning this because did you see anywhere in this formula the contributions, how much you have contributed or how much your employer contributed? No. So they totally disregard your contribution and your employer's contribution in the scheme. Because sometimes my clients, investors, come and say, who is a doctor, that Shubha, you know, I only contributed 14 and my employer contributed 31. Whereas I've got my annual allowance statement, it says I have contributed 43. Where is that 43 figure coming from? Because it has got nothing to do with your contributions or your employer's contribution. It totally disregards that, and it's only the growth. We're not finished as yet, because this was the growth in my client's 1995 scheme growth. On top of that, you'll have to look into the other scheme, 2015 scheme. Same formula. If you apply, you'll find out that the total growth in 1920 in 2015 scheme was 29,000. So what was the total growth? The total growth was, sorry, I'm trying to go to the earlier page. So the total growth was 11,624 and 29,021, which is slightly above 40,000. And that's why it was triggered, and that's why my client got this particular letter, right? So 40,000. Now you don't have to immediately contact your accountant and say, have to pay some annual allowance charge. No, you may not have to. Now the question will be, I will be asking that particular member that, have you looked into your earlier years? So earlier years means 1819. 1819 contribution was 29,957 through 15 scheme. This is 15 scheme. And this is 15 scheme. And if I add that on top of the growth in 1995 scheme in the same year, 1819, it was 8,550. So 8550 plus 29,957 was less than 40. One can look back 3 years. So the year before was 28,428 and 93 pounds. Again, he had some carried forward. And the third last year, it was 21,647 and 0. So 21,000. So he had 19,000-ish carried forward. And that's why you need to look into your last 3 years from the year you are calculating, whether you have got any carry forward. In this particular case, there are carry forward annual allowances. Of course, I don't have the time or intention to do the calculations now, but I just wanted to give you a flavor that where does this particular client of mine stand. I would tell him that, you have got carried forward annual allowances from the last 3 years, so you don't have to worry, right? So I'm not done as yet, because now this client does have a private pension also, right? So in that private pension, he contributes 500 pounds per month, which is 6,000 per year. So don't forget to add that 6,000 on top of your NHS pension growths. So one is contribution, the other one is growth. And this is the growth. If you look at opening value and closing value, if you apply the formula I just told you, don't have to, I'm just telling you. So the pension pot size at the beginning of the 1920 tax year was 105,000 and then 134,000 at the end of the tax year. So P1, P2. If you subtract P1 from P2, that's your growth in the pot. So that,
Dada, just one quick question. This is Shomavo. Can you hear me?
Shomabo, hi Shomabo. Hi, I can see.
Hello, Dada. Just you said 500 per month. So that we
Yeah.
have to add another 20%, which the HMRC gives to us, isn't it? So it will be.
No. Sorry. Let me stand
If
corrected.
you could clarify that one, please.
I meant 500 gross.
Right. Yes. Thank you.
So 500 gross means whoever is contributing in this particular case, my client, this particular client I'm showing the statement for, he contributes 500 pounds gross. That means he actually, the direct debit is for 400 pounds and he gets a top up of 100 pounds and he claims, because he's a 40% taxpayer, he claims another 100 pounds by filing a return. Does it make sense? Again, so he contributes gross 500 pounds. Actually, from direct debit, he pays 40 pounds, 400 pounds, and it's topped up by 100 pounds. So his total gross contribution is 500 pounds per month. And that's the figure HMRC is going to accept. 500 gross times 12, 6,000 pounds. So you have to add 6,000 pounds on top of that 40,000 something in 1920, if it makes sense. HMRC is only interested in the gross amount, not the net amount, the gross amount, if it makes sense, right? So going back to my slides. Sorry, I know you may have further questions on this. I'll go back to the other slide. Sorry. Right, so we have already discussed this. Now there is two linked questions or topics to annual allowance. Sorry, this is, as I said, that this is minefield, right? So bear with me, and I'm not trying to skip or jump, right? When I said that is how your annual allowance is calculated, the next question you're going to ask me, Shubha, you did mention about tapered and standard. Can you please explain that? So that's what I'm trying to explain now. From 1617, government made some rules, change in the rules of how to calculate your annual allowance. They said, if your taxable earning or slash net earning slash threshold earning, they're all same. I'm not going into the definitions, right? Other than saying that if you got gross earning, I'm not talking about pensionable earning, I'm talking about taxable earning. If your gross earning, if you take out the contributions you're making to your occupational pension and your private pensions, that leaves your taxable earning, which appears in your P60, your gross taxable earning after deductions of any deductible expense or pension contributions. If your threshold earning is over and above 110,000, this is historical, I will stand corrected, right? When you are comparing what I'm saying now to the screen, you'll find that they are different figures. Let me tell you the rules until 1920, and then I'll come to the current rule, which is 2021. You can see at the top of the page, it says 2021. So until 1920, the threshold income, which is the taxable income or the net income, was 110,000. If somebody's threshold income was more than 110,000, then they were asked to, or they were required to look into their their adjusted income. What is adjusted income? Now again, this can be very complicated, right? Adjusted income is, you start from your net income or the taxable income, add any contributions you have made into your personal pensions, just simply add the gross amount, add your contributions into your occupational pension and your employer's contribution into your occupational pension. I will define this, right? Pause the thought on that. Plus, any other earnings you may have, like as I mentioned, your bonus, your commissions, your dividends, your property income, your bank interest, your pension contributions, blah, blah. Everything is self-defined, barring the definition of employees and employers' contribution for a NHS member. For them, it's not simple. It's not the actual contribution amount. Though it says contributions, but they don't mean contributions. They mean the pension growth. So in that year, if your pension growth is 39,500, forget about your employees' contribution and employers' contribution, 14.5% or 14.6% and 20.6%. No, forget about that. It is your pension growth in case of NHS pension. So if your taxable earning is 110,000 and your pension growth is 40,200, then your total earning, imagine that you don't have dividend earnings, you don't have any rental earnings, you don't have any interest earnings, you don't have any private company income. Simply, if you add these two figures, it is over 150,000, marginally. 40,200 and this 110, it makes you 150,200 in this example. The rule says if your adjusted earning is over and above 150,000 until 2019-20 by £2, your annual allowance will be tapered or reduced by 50% of it, that is £1. Now forget about the example I just now give. Totally arbitrary example. Imagine you have done the calculation, your accountant has done the calculation, and they found out that your adjusted income, your threshold income is definitely more than 110 and your adjusted income is 160. So how much is your tapered annual allowance? First of all, is your annual allowance going to be tapered? The answer is yes, because both the boxes have been ticked. Your threshold earning is over and above 110. The beauty is, if your adjusted income is more than 150, but your threshold income is less than 110, HMRC said don't bother, right? So you have to hit both the boxes. So in the given example, you have hit 110, your threshold income is more than 110 until 1920, and your adjusted income is 160. So you are over and above the stipulated adjusted income of 150,000 by £10,000. So 50% of it is 5,000 will be taken off from your annual allowance. So your standard annual allowance is 40 and your reduction is 5,000. So your tapered annual allowance would have been 35,000 in the tax year 1920. Now this is where many of us go wrong. If you're trying to find out your tax liability and you had some carried forward annual allowances from the past years, you added up the carried forward annual allowances and found out that you are okay. you may not be okay because you'll have to do the tapered annual allowance calculations, whether you have been affected by that, even for not only for the year 1920, but also last 3 years, before you can conclude that how much carried forward annual allowances you had in 1819, 1718, 1617. I'll take time off on this. I'll quickly say what the changes are as it's showing on the screen in 2021. Now, all the senior clinicians, they were being affected, they were being penalized for earning more. They're working hard, they were looking after the sick people, ill people, they were earning, and then they were penalized for earning, right? Looking after their patients. So the senior clinicians, they filed in a consultation request, right? And the government looked into it, and then towards the end of the 1920 calendar year, the government said, conservative government said that, sorry folks, we have got the Brexit, imminent Brexit, and secondly, we have got a general election. So we don't have time to sit on this and conclude. So we will give you one-off window where if you think that you have surpassed your annual allowance and you are deemed to pay any annual allowance charge, you have to do the calculations with help from your financial advisor and tax consultant. If you find yourself in that position, you opt for scheme pay. I will separately discuss that because there were some questions around scheme. For the time being, let me just explain that historically, if your annual allowance charge was below £2,000, you had to pay from your own pocket. They have changed the rule now. So now, even if your annual allowance charge payable through NHS scheme only, not private pensions, through NHS pension scheme only is below 2,000, you are still allowed to fill in the scheme pay. So what is scheme pay? So one option was either you pay from your own pocket or you fill in a form called SPE2. You don't have to remember, SPE2. And in that box, you are basically authorizing the NHS BSA, pension department, through them, basically HMRC, to deduct the liability of this annual allowance charge, to deduct from your pension pot back-ended when you are reaching your pension age. Of course, they will not only deduct the annual allowance charge, but also a little bit of interest accrued between now and when you are retired. They will deduct that amount back-ended.
In that cup.
Now, sorry, if you want to ask me any questions, please note it down. I'll definitely answer it. Right? So coming back to this, for 1920, the government said that, sorry folks, I wanted to sort this out for you. I don't want to discourage to work less, right? Encourage to work less. Rather, I will solve it, but for the time being, I'm trying to buy some time. Fill in the scheme pay, SPE2 form, and we have got special arrangements with your trust. So you have to check with your trust whether your trust entered into the agreement or not. If your trust agreed, they'll pick up the bill of paying the annual allowance charge back-ended when you are due for your pension. So if you fill in the scheme pay, they will deduct from your pension pot, but it will be refurbished, replenished by your trust because they will pick up the bill. This was one of arrangement in 2019-20. So if you think that you have surpassed your annual allowance, stipulated annual allowance or your tapered annual allowance in the year 1920, you have to disclose that in your tax return, for which the last date is 31st of January 2021 for the year 1920. You don't pay immediately. You'll have time until to pay 31st of July 2021. So when you furnish your tax return on 31st or before 31st of January 2021, you mention about that annual allowance charge. The good thing is that it also says in the NHS rule that if you haven't received your annual allowance calculation from NHS BSA, you can estimate and fill in the form because you'll have 4 years to come back and amend it. But if you don't fill in, you lose the opportunity to go back and amend it, and then you'll have to pay it. So if you think that there will be some annual allowance charge liability, please fill in the form, estimate it. Even at one place I saw in NHS BSA documents, even if you want to pay only, sorry, BMA document, that even if you want to pay 25 quid, pay that. Because by paying that, you're buying your right to go back and amend it in the next 4 years. If you don't fill in the form, you are forfeiting your right. So in that case, you can't go back in future and try amending it or try paying it. So to be eligible to pay it or opt for scheme pay, you have to fill in the forms, right? Sorry, coming back to the current changes. Fast forward to 2020, 21. 1920, they couldn't make the changes, so they asked the trusts to pay it on behalf of the clinicians. Come 2021, they said that let's change the threshold earning and the adjusted earning definitions. So on your screen, you can see instead of 110,000, they have now redefined the threshold earning. So before you are affected by the tapered annual allowance, they will look at your threshold income, or which is taxable income or net income. It has to be below 200,000. In that case, you are not affected. But if your taxable income, after deductions of pension and other deductible taxable allowances, if it's over 200,000, then they will look at your adjusted income also. And I've already reiterated that the definition of adjusted income is not only your taxable income plus your pension growth in NHS pension growth, sorry, not pension growth, pension contribution, if you are still contributing in your private pension SIP, plus your dividend, rental earnings, private practice earnings, your interest earnings, and any other earnings you may have. And if you're over and above 240,000, then unfortunately you are still affected by tapered annual allowance. But I can understand that by increasing these goalposts or the threshold definitions, a lot of you won't be tapered anymore. So I'm following the flow chart. So I've already told you that one thing in the previous scenario, if your adjusted earning is more than 210,000, up to 210,000, you're over and above 150,000, the stipulated adjusted earning by 60,000 pounds. So 50% of 60,000 is 30,000. So your tapering will be 40,000 minus 30,000, 10,000. Your tapering will stop at 10,000 level because your reduced tapered annual allowance cannot go below 10,000. Even if you've got earnings, adjusted earnings over and above 210,000 until 2019-20, your minimum tapered annual allowance will still be 10,000 pounds. And that's why in one of the slides I showed you that your pension annual allowance can go as low as 10,000 pounds through tapering. I've already said that it's not the contribution, it's the growth in your pots for your NHS pension. And usually in a year, I know I've got clients who are very young, 38, 40, and they became consultant. And suddenly from 60,000, 55,000, their wage went up to 80,000 pounds or 84,000 pounds, whatever it is, right? In that particular year, you will definitely go above the annual allowance threshold. You definitely will be, because suddenly there'll be a big jump in your pensionable pay. And this pensionable pay also can be sometimes through large pay increase, sometimes excellency award, or some additional work, and so many other things, right? Okay, so look out for those sudden jump in your pensionable earnings. Now, one of the questions was that if I'm working for this COVID additional sessions, right, is my pension is going to grow at a bigger pace? The answer will be yes, depending on whether your increased pay through the additional sessions is pensionable or not. I'll cover in a future this thing that you can download from NHS, that which type of earnings, incomes are pensionable and which are not. So if your increase in income is through an element which is pensionable, then unfortunately it will impact on your pensionable pay, total gross pensionable pay, and it will impact on your annual allowance or growth in the pot. So what happens if you go over and above annual allowance? either tapered or standard, you'll have to pay the taxman annual allowance charge at your highest marginal rate. So if you're a 40% taxpayer or a 40% taxpayer, and if you are over and above your tapered annual allowance or standard annual allowance, say in this example by £20,000, then you'll have to pay 40% of 20,000, which is 8,000, or 45% depending on your highest marginal rate, 45% of 20,000, which is 9,000, to the taxman in that particular year. There is no opting for scheme pay or anything. You have to pay it on yourself, right? You know, the death in service benefit, one of the better benefits through NHS pension, which is usually 2 times, of your pensionable pay, which is 2 times. Now there will be a difference between pensionable pay and taxable pay. I will recommend, if you want to know the difference in a particular tax year, look into your last wage slip, pay slip of the tax year, which is for the month of, because you're paid monthly, so which is in the month of March. If you go back and pull out your pay slip for the month of March 2020, you'll find out that how much was your total pensionable pay in the year 1920 and how much is your total taxable pay in the year 1920. And you'll find out the difference, because your taxable pay is always, usually, unless you are opting for salary sacrifice to your pension or some leased cars or anything. So in a standard run-of-the-mill example, your pensionable pay will be higher than the taxable pay, because from your pensionable pay you will deduct your pension contributions and then pay tax on the residual amount, because your pension is not taxable. Pension contribution is not taxable. Of course, once you are affected by pension, you can look into other areas like investments, if you have already hit or very close to the lifetime allowance. So I'm sorry. So that's my usual slides, right, which are relevant to you. I finished with those. Now there are certain things which are linked, which I will cover eventually, right? Because we are already, it's past 1:30, so already 1.5 hours, right? So I will answer. Hi Vivek, if you're with me, right? I will try answering some of the questions, right, to start with. I have got already, as I mentioned, I went to the.
Shubham, can I just give you a pause? You must be tired a bit as well.
Yes, yes.
Vinod is back here. Shubho, why don't you have a glass of water and look at the relevant questions you already have been emailed. But I think there's so many questions, it's a full flood. I mean, you had 25 questions you have compiled, and on the top, there are plenty in the chat box. So I don't know if you are in a position to answer all, and are people in a position to sit for an hour or two, and normally I won't be able to. So what I would suggest you, why don't you take your 3, 4, 5 minutes, see what is relevant for the presentation today, and if members are happy, we will put up a poll on the system just now if they are keen for asking you to come again. And of course they can contact you directly as well. So if you don't mind putting up on the screen your address details, so people can take a photograph and contact you directly as well, if that's okay with you. And regarding the questions, of course, if you could cater to what's relevant to the level of presentation you have done today, and we will put up a poll shortly while our guest speaker for the next Sunday is going to introduce himself and what he's going to do, who is Dr. Vinod Sangravalu, shortly. And then we will have a poll. If people are keen for you to come again, we would most like to invite you again for the next level, and also for the questions which are of common benefit but could not be answered today. Is that okay, Shubho?
Yeah, perfectly all right. Perfectly sounds, because I needed some, this thing.
You take a break, just put your address, take a break, have a glass of water, think what questions you can answer over next 10-15 minutes, cover 5 or 10 major important topics, and then we will call it a day off after that. While I'm calling Dr. Vinod Sangravalu. Vinod, are you there?
Yes, I'm here.
Yeah, Vinod, would you like to, I think we need to do stop the screen sharing. So if everybody has taken the picture of Shubho's details, we will be taking that screen off in next 10 seconds so that we can get introduced to Vinod for his presentation. He's coming up on the next Sunday. And Anup, are you happy to raise a poll, please, meanwhile, regarding willingness and keenness of the audience to invite Shubho again sooner than later for another level of presentation and for more questions which he may not be able to answer today, if that's okay.
Yes, Vivek. Thank you. Thank you, Shubho. Shubho, just for the members, those who are still here, please don't feel the meeting is completely done. We know this just giving a 2 minutes of his introduction. The meeting will be continued after that with question answer session. We understand the meeting has been a bit lengthy and exhaustive, so there is a possibility not all the questions will be answered. So we are hopefully expecting another meeting which just question and answer session in the near future. So keep hold on that, please. Yeah, Vinod, please, if you come in, please.
And after Vinod, Shubho will be answering some questions which are very relevant and important over next 15-20 minutes so that we can wrap up latest by 2 o'clock, if that's okay with you all. Okay, over to Vinod now.
Thanks, Vivek and Anup. Can you hear me okay and see me okay?
Yes, I can see you. I can hear you.
Great. My computer has just died down a minute ago, so I'm connecting through my phone at the moment. It's a very timely mishap. Hi, everyone. My name is Vinod Singaravelu. I'm a consultant psychiatrist. Many of you perhaps know me from our WhatsApp group, Financial Freedom WhatsApp group. So I'm joining Anup and Vivek in the Zoom meeting next week. I think the timing is slightly bit different. It's 11 o'clock, I believe, instead of 12. Vivek,
are you comfortable at 12? Then we will keep it at 12 because it's a fixed time. But if you can't do it, then we have to reschedule it.
Yeah, well, we can maybe confirm that outside of this meeting as well, I guess.
Sure.
So I'm going to talk about my experience and learnings that I've done and the journey that I've been through that led to my current kind of experience of investing in stock market. So I've invested starting in India a little bit, and then I tried various things in UK, and currently I'm investing quite a lot in the US stocks, and I'm supporting along with other colleagues in the Financial Freedom WhatsApp group, kind of helping other people understanding basics of stock market investing and growing your wealth in general. Looking at financial freedom, kind of financial habits and stuff. But the talk next week is going to be about the journey and the learnings that has happened in the stock market investing. So that's what I'm going to spend some time next week with you all. I'm preparing a presentation as well. Hope it is interesting. So it's more of a kind of reflection. Hopefully it will help you to kind of also identify parts of yourself, the pains, the questions, the fear that we had, and the ups and downs that many of us might have had in the stock market. So I'm looking forward to the meeting next week and sharing my experience with you all. See you next Sunday.
Thank you, Vinod. That is highly inspirational and helps colleagues to go beyond what we have been doing with throughout our life in our just in our profession, because we know that all kind of seeds exist in everybody, and it's a matter of time which one starts germinating. Nobody knows, but unless and until the fertilizer, the nutrition is there and the right timing and conditions are there, and then there is a gardener like you and Shubho, then the seeds may fertilize and germinate further. So that's the whole aim of the meeting, is like germinate our financial seeds as well, besides other things we are moving and me and my metaphors. So if Shubho is ready and people have taken their comfort break, those who wanted to take a deep breath, couple of breaths, and then we let Shubho to take over. And of
Vivek,
course,
can I just say?
Yeah, sorry.
No, someone just sent on chat or WhatsApp saying, can I just join the WhatsApp group? I'm afraid WhatsApp has a limit of 256, which has been hit a couple of weeks ago. So I'm so sorry. We are exploring options of other social media so that we can expand the group membership as well. In the meantime, if you're interested in some of what I do, I've created a page. It's called buymeacoffee.com/growwealth. So it's buymeacoffee.com/growwealth. I'll put it on chat as well. It's free to use if you want to look at some of the free resources there. You don't have to pay. Well, when people want a bit more of an input from me, specifically like mentoring or watch list and things like that, they can become members, but it doesn't have to be. There are lots of resources that I post most days. And if you like what you read, share it with others. And if you're really kind of glad of what you got from the website, you can also contribute. It's completely up to you. Have a look into that. You might like it.
Yeah,
I'll
and
put it on the chat section.
wonderful. Thanks a lot. That was very useful message you picked up. And Anup, if you can just post the survey while I'm finishing one more announcement regarding Shubho. If you can post the survey meanwhile. There are a couple of spaces in our WhatsApp group, 2 or 3 spaces I noted today morning. The group is by the name of Serene Doctors. I'm just posting the email address if you are not connected to us. So if you can email me, and I will send you the link of the group before they get grabbed up. If you want to be a member of our WhatsApp group by any chance. So the message is coming now. This is the email address. I'll try if I can send the link of the WhatsApp group as well. I'm just doing that while Anup is posting the survey, and then we will let Shubho take over.
And thank you very much, Vivek. Right. First of all, let me very quick.
And Shubho, Anup, are you posting the survey?
Vivek, I think we can carry on with Shubho,
Okay.
otherwise the time will run out.
No problem. Let's carry on. Shubho, let's take on now.
Yeah, very quickly, Vinod, that sounds really interesting, right? And definitely I've noted down your website. I'll go into that, right? So all the very best for the next week. Regarding the queries, what I will do, what happened, I received probably 30 questions. Can you hear me all? Can you hear me?
Yeah, Shubho, if you go on your question answer slide, and we can go through up till we can, and then we can have a question answer session separately sometime in the next few weeks time possibly.
Correct.
Otherwise it will get randomly haphazard if we just randomly pick the questions. Yeah,
Correct. So yes, that's what I was trying to say, that there were quite some queries, and I've taken off the ones which were common. Sorry, I'm trying to go to the end of this thing. And so I'll very quickly choose the ones, right? No disrespect, all questions are equally important, right? All questions are very important, and I'll definitely answer it if I come back. And but depending on the level I covered today, right? So if I try answering some of them, they may sound slightly out of sync or complicated. So I will choose some questions which are easily comes as a follow-up from the topics I've already covered, right? So yes, I have already mentioned about the different schemes. So question number 2, if I look at the question number 2, that if somebody is a member of a particular scheme and he or she is part-time, the NHS rule says that if somebody is, say, for example, works half, right? So instead of full-time, they work only half. That means full-time is 12 PA or 10 PA if they work 5 PA, right? In that case, it will be considered, instead of, if somebody has worked 20 years, it will be considered as 10 years, half the time. But when they are calculating the final salary in 1995 scheme, is the best of the last 3 years. So when they're calculating the final salary, they will take the full salary, not the half salary, right? So de facto, it works out the same. So if they're taking the full salary, and if they're working the half working hours, right? In that case, it still is half of the pensionable earning or half the accrual, right? So they will take the full pay, uprated full pay, whole time pay, equivalent pay, but they will consider the actual hours you have worked, if it answers, right? So there will be a difference between a person who is working 10 PA and a person who is working 5 PA or 6 PA, right? There'll be a difference because they are only doing half of the hours. But so far as taking the pensionable pay, it will be always taken the whole or full-time equivalent final salary, if it makes sense. I will, in one of my later meetings, I will give you some example because that makes understanding easier. This is very important. How to read the total reward statement, and I will go back to the differences I mentioned about how the SPPA statement is different from NHS statement. So since your NHS England and Wales statement is slightly different, how it looks and the information it gives you from the SPPA statement, Scottish Pension Authority statement, you have to look for your pension, your tax-free cash if available.
Shubho, we can't hear you for last 30 seconds.
Sorry, can you hear me?
Shubho, can you repeat?
We can hear.
Sorry, is it some? Sorry, can you hear me?
We can
Yes.
hear you. No worries.
Yes.
I think it was Vivek's audio, maybe. We could all hear Shubho.
Right. Shout out if you can't, right? Okay. So what I was trying to say, that there are 5 different things you're looking into. 5 different things you're looking into. Because sometimes there are errors. So there is no reason for things to be granted. I personally know 2 cases where I shouted out that something doesn't look right. So let me explain what you're looking at. First thing you're looking at is when you're looking at your because there will be 2 segments. One will be for the 1995 or 2008 scheme, and then your 2015 scheme. So you will receive 2 different statements in your pensions, TRS statement. One will be that when did you join your pension scheme? And how long have you been a member of the scheme? Mind that if I can go back to the way we calculate the pension amount is 1/80th times the number of years you have been in the scheme times your final salary. Now, if they got the number of years you have been in the pension scheme wrong, then unfortunately your pension amount is also calculated wrongly. So please double check that the date they have mentioned when you joined your 1995 scheme is correct. 2 is that you are in full-time or part-time. If they have mistaken it, you need to shout out. Then you're looking at your pension amount. I will suggest that you look into both the things. How much is your by default pension amount and the tax-free cash? And how much is your reduced pension amount and the maximized tax-free cash? Now, what I didn't mention, I'm going to mention now. What I didn't mention earlier, if you use the formula that how do you calculate your pension pot size, just to have a comparison that where do you stand against your lifetime allowance. If you use the same formula, let me reiterate the same formula, 20 times your pension per annum plus the tax-free cash, as simple as that. 20 times the pension plus the tax-free cash. And you'll have to do it for your 1995 scheme or 2008 scheme plus your 2015 scheme. Now, if there is no tax-free cash, as there is no tax-free cash in 2008 scheme and 2015 scheme, tax-free cash element will be 0. So it will be only 20 times of your pension. Now, if you use the formula where it shows what is the pension and tax-free cash, and then option 2, where is the maximized tax-free cash and reduced pension, you'll find out that both the outcomes are different. For example, by default, it's showing your 1995 scheme pension is £20,000 per annum and 60,000 is your tax-free cash. Apply the formula. 20 times your 20,000, 400,000 plus 60,000, 460. But in the second option, it will show you that instead of 60,000, you can have 90,000 of tax-free cash, up to 90,000 of tax-free cash. Totally hypothetical example, right? But for 30,000 additional tax-free cash, divide by 12, so £2,000, right? You don't have to do the mathematics correctly. £2,000, your pension will be reduced. So instead of 20,000, it will be 18,000. So time 18,000 by 20 is 360,000 plus 90,000 is 450. So the first option, your pension pot was 460. With the second option, your pot is 450. I'm just giving you the concept. Don't hold me for the mathematics. I'm giving you the concept. That means when you apply the formula with the maximized tax-free cash and a reduced pension, your pension pot will always give you a smaller pension pot size. And 9 out of 10 doctors prefer to take the maximized tax-free cash. Mainly 2 reasons. One is, when you opt for maximized tax-free cash, it's upfront. You are getting it now. And it's tax-free. 2 things. Upfront, getting it now, and then you get it tax-free. And secondly, the second thing is that means there is a life expectancy. If you don't want to take it as maximized tax-free cash upfront, you get the increased pension amount drip fed to you over the next so many years until you live, and it will be taxable. So if you are a 20% taxpayer or 40% taxpayer, the additional amount you'll receive as your additional pension amount, because you agreed to take a reduced tax-free cash, though we will get the pension, but since pension is taxable earnings, so you'll get tax deducted pay. And of course, some people are worried about that, how long I'm going to live. So rather, I will take the cash now. I'm not saying which one is better, because it's always, I recommend that do the sensitivity, look at your circumstances, and then decide. But factually speaking, 9 out of 10 doctors opt for maximized tax-free cash. So if you're taking the maximized tax-free cash with a reduced pension, you need to apply the calculation formula for lifetime allowance, the second option. And in that case, your lifetime allowance will be slightly less. So these are the things you're looking at: start date, the total period in the in the pension scheme, your tax-free cash amount, your total pension amount, both for 1995 scheme or 2008 scheme and for 2015 scheme, and use the formula and add them up to get a flavor that where do you stand against your lifetime allowance. You need to know that, right? Otherwise, you wouldn't know when you have to pay your lifetime allowance charge. I'm going to the next questions now. Answer is yes. I'm looking at answer number 4. Will it affect annual allowance if they increase 1995 scheme until 2022 scheme? Right. It depends, because the way they calculate the final salary is slightly different for 95 scheme and 2015 scheme. 2015 scheme, if it started from, hypothetical, I'm giving an example. If it started in the year 15, 16, 80,000 pounds, you just became a consultant. And then it progressed to 86,000, 89,000, 90,000, 91,000, 93,000. And then suddenly after 7 years, it became 97, and then go on. So you can see, if you add all these salaries, pensionable salaries, 80, 84, 89, and so on and so forth, your average, and then you are now 67. If you work until your normal pension age, assuming that your normal pension age is 67 through 2015 scheme, your average is probably 100,000. So that will be the career average earnings when you are trying to calculate your 2015 scheme. Whereas if you are allowed to be in 1995 scheme after the McLeod judgment, right, until 2022, so additional 7 years will be into your 1995 scheme. And in 2022 or until the end, if your final salary, they will take the best in the last 3 years. So in your working life, in your 65th year, 66th year, and 67th year, if your pensionable earning is 120, so can you see that the career average was 100, but the final salary was 120. So obviously, your 1995 scheme calculation will be more than 2015 scheme. In that case, your pension growth will be a lot higher. So I don't know, I gave you an example, but if there is not much difference, not much growth or increase in your pensionable salaries in the latter years, then there may not be much difference between your 2015 scheme benefit and 1995 scheme benefit. But if there is a difference in the pensionable earnings through career average and final salary, then yes, 1995 scheme will mean that your annual allowance will be affected more. Yeah, this is a simple one. If you exit from your pension scheme through deferment or just opted out. Deferment means you are 60 today and you thought I will continue working for a few more years. So what happens to that 1995 scheme? It's deferred because you are eligible to draw from it anytime. In fact, you are eligible to draw from it anytime after age 55. That's the minimum pension age in UK. But you don't get the full benefit at age 55 because if you can remember the actuarial reduction sheet I showed you at the beginning of the discussion webinar, it says that you get your full pension benefit when you hit your normal pension age of that scheme. For 1995 scheme, your normal pension age is 60, right? So you get the full benefit when you hit 60. But if you're trying to take it earlier, there will be some actuarial reduction. So if you have already hit 60 and you are not drawing from it, it goes up every year in line with the CPI. We don't know how much the CPI will be in the future years, but it goes up in CPI. So obviously, when you draw later drawings, your pension will be marginally higher than had you been taking it from a particular stipulated age. So that's why I said that it's an easy one.
Can I interrupt here? Sorry. On that same. My name's Anand. Thanks for explaining that. My question is, let us say I retire at 62 and start taking the 1995 pension, but don't take the component of the 2015 pension. What happens to that component?
Yeah, so right. There are two angles to it, right? One is, have you fully retired? That means, have you stopped contributing into your 2015 scheme? If the answer is yes, then there is no actuarial reduction because you are not drawing from your 2015 scheme as yet. You may or may not draw from your 1995 scheme. That's not affecting you. If you decided to draw from 1995 scheme, as you just mentioned, fair enough. You are getting from your 1995 scheme. You are well within your right to not to draw from your 2015 scheme. But if you don't contribute into it, that means it's not going up in that pace. It is now called deferred 2015 scheme because you have stopped contributing into that, but you're not drawing from it as yet. So there is no actuarial hit, but it has stopped growing because you're not contributing into it. So the contributional increase has stopped, but it's still going up every year by CPI. But on the other option, as you mentioned, that if you're drawing from your 1995 scheme and you are also working another, say, until 2062 or further age after 62, if you're still contributing into that, in that case, there is no CPI increase because you're a live member in the 2015 scheme. So they will use the formula every year. 1 year of pensionable earning, pension will grow every year by 2,500 usually, right? If your salary is somewhere around 100,000, pensionable salary is 100,000, right? So if you're not contributing, it goes up by CPI. If you're contributing and if you're a live member, then it goes up in line with the formula. The formula is 154 times your career average earnings time the number of years you have been in the membership. Sorry, Vivek, do you want to say something?
Yeah, we have got now 1 minute left to 2 o'clock. And
Yeah, so,
if you could just now give us final messages to take home and how to contact you, people can, so that whatever there are urgent priority queries people may be having, they can contact you directly by email or phone, however way you are going to share with. I want to share with you that people want you back. There's 64 people polled and 97% want you for another session. And I think we shall keep that as a Q&A session of all the questions which has so far not been answered, and maybe more questions in the same session instead of going to the next level. Or maybe you may bring some slides which are related to the Q&As asked and are of next level. So you can assemble it accordingly. And if you can maybe come on the this month on 17th, we have got a slot free on Sunday. If you are okay with that, or you can tell us later. what is the slot available, because our 2 Sundays are booked, but 1 Sunday is still free in this month, in the middle of the month. And I'll leave it to you to how to close it further.
Yeah, fair enough. Right. So first of all, thanks again to Vivek, Anup, and your team. And right, if you don't remember my or haven't taken a screenshot of my contact details, I'll encourage you to go to my website. Right, going to shubhokundu.com, Shubho Wealth Management, WM stands for Wealth Management.com. Right, and you'll find all the details necessary. Two is, I deliberately, kept the pace, the pace I was in my today's webinar, because I wanted to cover it in a reasonably detailed. You can go for the details, of course, right? Okay, but reasonably detailed. We have got time constraint. We have got attention constraint, especially over virtual webinars, right? So that's why the pace I chose. Now, since I have completed the structure, it gives me the license to answer the specific queries. So out of the 25, 27 plus the chat queries, which were again another 9, 10, if I'm not mistaken. So out of those 35 queries, I've only covered 6, 7. So in the next meeting, yes, I'm accepting 17 because I'm not working on Sundays, right? So Sundays are free for me. So that's easy answer that yes, I'm okay. Another couple of hours on Sunday, say 12 to 2, similar setup. And this time I will only try addressing the queries. And the queries, what I will do, though they came to me in different orders, but I will, I will sequence them in a way where they are slightly, progressing in a sequence, right? So that I will cover the ones which I've already covered in my content, and then go to the more complicated ones, right? If that's okay with you, right? And please be in touch, because these are all generic. Because of data protection, I can't give you customized information, right? So and that's how I spread my business, honestly. Now this is my marketing phase, right? So feel free to go to my website, contact me, and if you need any specific help, right, I'll be more than happy. So on that note, with a great big thanks, and this is the new year, hopefully 2021 is a lot better than 2020. And since I am the probably only non-medical fraternity person, and I'm speaking to all the medical people on behalf of the non-medical fraternity, I give you a massive, massive thanks. Every day you are exposing yourselves, you're helping the sick, the ill. So great job done. Thanks a lot.